of research at Folio. And what this presentation is going to hit on is, I think, a really unique way to use real-time consumer insights to kind of inform your trading hypotheses and inform your investing hypotheses, because you're using and listening to what consumers are talking about and what they're buying. And so what we do is we listen in on social media, on publicly posted comments and things of that nature for mentions from consumers who are talking about publicly traded brands. And we're able to do this because we have a partnership with Twitter. And so what this does is it gives us access to the full fire hose of tweets that are publicly shared. And it also allows us to go back in time all the way to 2012. And so this gives us a really robust sample size. It allows us to accurately back test for the different companies and brands that we're listening for and different trends. And it really creates a really nice sample size for us. If you guys are interested, on Twitter's developer site, they have a case study about our partnership and how we're using this Twitter data to really get this edge from a trading and investing perspective, just by listening to what matters the most to consumers. And one of the ways that we do this, we've built this enormous brand map. So you can think a lot of companies, they might be tracking cash tags. So just the mentions of people or from investors who are talking about a stock, or they may be listening for really high level mentions of a company name, but we're actually listening for the products themselves. So all the different ways that a consumer could be talking about engaging with a publicly traded company. In fact, we segment these mentions, these investor mentions versus these consumer mentions, because what matters to us the most are these consumer mentions. I like to think of this as, back in the day, people used to go and they would, sit in parking lots of retailers to see, okay, is there a full parking lot? Because typically that's a good sign. Is there an empty parking lot? Maybe the company's having some trouble. We're doing this just digitally, and we're doing this in real time. And these are just some of the examples of the brands that we're listening to underneath the category of Apple. It's more than just iPhone, shockingly, even though the iPhone is very important. I also want to point out that our tagging, our algorithm is customized for every single company, every brand that we cover, so that we understand how a consumer may be engaging with that brand. So for example, the way that a consumer talks about their Apple Watch, not all consumers are going to use the Apple appropriate way to speak or even spell. Some people might just indicate that they closed their rings today. And that for us is a sign that a consumer is using an Apple Watch, which is a good indicator for someone who's active in the Apple ecosystem. So to give some scale for the type of data that we're processing, we're ingesting anywhere between 3 and 5 million tweets a day. And when I say this, I mean that is how many tweets actually hit on one of the keywords for these publicly traded companies that we're listening for. So that's a lot of tweets. We also, I think, is what's really unique is the way that we present this data is we utilize these snapshots. I want to call that out because I think that you guys all know what a company and a brand and a keyword is, but a snapshot is a little bit different. And we invented this because what we're ultimately trying to do is correlate our mentions, so mentions of consumers who are talking about purchasing or using a service of a publicly traded company, to revenue. And this makes sense because revenue or purchase intent, that somebody's saying, I just bought an iPhone, that's a good indicator for revenue, especially in the current quarter. Now, companies, though, they're constantly acquiring new brands, they're constantly releasing new products, they're selling off brands, and all of these big events can impact when we should attribute a mention to a specific company. So one good example of this would be Whole Foods. So obviously Amazon has acquired Whole Foods a couple of years ago. And prior to that acquisition, those mentions should not have been attributed to Amazon. Any mention of Whole Food shouldn't have counted for Amazon because that wasn't actually going to be reflected in Amazon's revenue. And so there's a pretty unique on and off switch for when these mentions should be attributed to the parent company. And we track these. And just to give scale for, in the over 400 companies that we track, there are more than 21,000 occasions of this, of either a specialized product launch, a brand launch, or a brand actually changing hands, or even, going private. So I think that that's something that helps improve our accuracy, especially when we found whenever we're back testing to revenue. And then lastly, we realized that it's really helpful to understand the consumer macro environment, not just the companies and the brands and the products that consumers are interacting with, but, big picture behavior changes, because that really influences, what could either really prove to be a huge, tailwind for a brand moving forward, or what could really hurt or be really difficult, a large hurdle to overcome for a brand moving forward. And so these are some of the examples. This just showcases how we kind of pick apart a tweet and how we pick apart a mention. And we're looking for really 4 things. First is, it's not on this, but it's just that brand mention. So that Skechers mentions in the tweet that you're looking at. This tells us that the consumer is talking about Skechers. So this is what flags this mention to even be analyzed by us in the first place. And then we're looking for a couple of other indicators. We're looking for an indication that the consumer has spent money with this brand or product, so that purchase intent metric. And then we're also listening to understand how the consumer feels about this product. Was it a positive experience? Do they like the product? Do they not like the product? Do they have, is there a pain point that they're expressing? Because whenever consumer happiness changes over time, that's really indicative. So this gives us a really nice baseline to understand, okay, this is about how happy consumers are with this product. This is how this happiness is performing versus last year. And also this is how, this brand or product is performing versus peers. And we've actually had our data tested. Georgetown University did a study, and they found that our data, specifically purchase intent, was predictive of both upcoming sales and the unexpected component of sales growth. And so I think this is really, really the edge that we're looking for whenever we're researching these companies and trying to understand what matters to the consumer, is because we want to catch these unexpected overperformances or underperformances before they're reported. And so one time, or last month, I believe, whenever I presented, people were asking me, okay, well, how do I use your data? And so this month I wanted to include some examples for how this actually translates to real life, because it sounds complicated on the back end, but it really makes sense whenever you see it presented like this. And so one thing that we, provide our members, and we have individual members, we have hedge funds, we have quant funds, we have institutions. And one thing that we deliver are opportunity alerts. And so these opportunity alerts are times when we feel that consumer demand is either rising or falling in the opposite direction of the stock. So, maybe we think that the stock is oversold or overbought. And then we also watch this, though, for continued momentum or continued underperformance. So in some cases, we use these opportunity alerts to say, okay, this company has been doing well and now it's doing even better. Like, this is still a strong opportunity for a long-term investor, and vice versa. So opportunity alerts should really be thought of as a long-term, investment tool, just to inform and help generate ideas if you're looking for things like that, and help inform your trading hypotheses. And so the first example I want to use is Celsius. And Celsius caught our attention a couple of years ago. It is I would say, more healthy energy drink. And we really saw it taking off with consumers. And so in 2021, we put out a bullish opportunity alert. And this is just a screenshot from the alert itself. When shares were trading, well below $60. This is kind of what we're looking at, and I think it shows our data in action. So that green line, that's the average number of consumer demand mentions per day. that we were recording. And you can see that that was growing at a tremendous rate, up something like over 180% year over year. And in the meantime, shares have pulled back a bit. We also like to compare these companies versus peers. And I think that this chart is really interesting because it plots that change in purchase intent. That's on the x-axis. So how have mentions from consumers who are talking about buying one of these energy drinks changed versus 2019, and how they changed near term, even on a quarter basis. So the further to the right that a company is on this chart, for us, the better. And then on the y-axis, you have that consumer happiness that I was talking about. So these are the percentage of sentiment mentions that are positive leaning. So the percent positive mentions, the higher on the scale, the better. So whenever we see a company on a short-term and long-term comparison, like Celsius is right here, that for us is a really bullish opportunity. I'm gonna get into kind of the results of that opportunity alert later, but we saw shares trade higher than $108, I believe. So this was, definitely we maxed out our time frame here whenever we were looking at Celsius, and then we realized in January of this year that shares had pulled back. The stock was sold off alongside many other growth names at the beginning of this year. And meantime, though, consumer demand was starting to rise again. And so while there was somewhat of a tempering in demand growth that you can see there, this green line, it's going up again. The demand was growing at a rate of something like 71% year over year, while this shares continue to fall. So this to us helps to bring this opportunity to light. It's starting to look like what I call a little Pac-Man chart, because you see consumer demand going one direction and you see the share price moving in the opposite direction. And then in the meantime, whenever we took a look at how Celsius was performing versus peers, it's still outperforming in demand growth and in the percentage of positive mentions, so how happy consumers were with its product. And so you can see on this chart, this each mark is where we issued those opportunity alerts and the corresponding performance. So this is one that I think just showcases how you can use data just to help understand, okay, maybe the market's getting it wrong here, or maybe the market's missing something here. Another product that we have, which I would say is more suited for active traders, is our Sunday earnings sheet. And we put this out every Sunday, and it covers all of the companies in our coverage list that are scheduled to release earnings in the upcoming week. And I want to note that all of the companies that we cover, these are going to be really consumer facing companies. You look at a CarMax, you look at an airline like Delta, you see Bed Bath & Beyond. These consumer facing names are the ones that we focus on, because obviously these are the ones that consumers are actually going to talk about. People aren't necessarily going to talk about which gas station they're going to if they go to the gas station. They might just talk about going to the gas station. So just as a caveat, that's why you're going to notice a lot of these examples are very consumer facing names. But what we saw last week prior to Bed Bath & Beyond's report is that, the buzz growth, so the mention volume from consumers was falling. You can see that right here in these double down arrows. Demand growth was also falling. And really, we use all of this information and we back test each company so we understand from a historical performance perspective how to weight the mention growth, demand growth, and happiness growth for each company, and every company is different. And then we use this to generate an earnings score. And the way that we score this, a positive 100 is the most bullish you could be. A negative 100 is the most bearish we would be. Anything in between plus or minus 20 is pretty neutral. So for us, Bed Bath & Beyond coming in at a negative 42, that was a comfortable bearish stance for us heading into earnings, because we theorized based on our data that fewer people were shopping at Bed Bath & Beyond. And you can see what this looks like in real form, because this green line, those are consumer mentions of shopping with Bed Bath & Beyond, either in store or online, any way that you can interact. And you can see those mentions were falling on a quarter-over-quarter and year-over-year basis. And really, they recorded a pretty small holiday bump. There was a little bit of a holiday bump, but not anything like the prior year that we had recorded. And so we were worried about some weakness ahead of this earnings report. And what's really neat is, we're tracking this data every single day. So as soon as a day ends at midnight, that caps off the day for us, and we add that to our data. So we can see as soon as a company's quarter end ends how we expect that company to perform from a revenue perspective and how that growth looks like and whether or not we think that's going to meet expectations. And you can see these were the results after Bed Bath & Beyond reported, very much in line with our data, and it makes sense. So this was one, this was a win we were glad to take last week. And so now I'm kind of switching modes, but I wanted to highlight some names that we're watching right now. So these aren't necessarily names that have an open alert out like the opportunity alert that you saw, and they're not necessarily names that are reporting earnings, but they're names that are on our watch list because they're either overperforming or underperforming. So the first one that has caught our eye recently is Upwork. And Upwork is a freelance platform, if you aren't familiar. It's a way for companies and businesses to utilize freelancers for tasks, short-term and long-term. And it also enables workers to, sign up as a freelancer and bid for jobs and bid for work and support themselves remotely, essentially. And Fiverr is probably Upwork's largest competitor, at least in our universe. And what you can see on this outlier grid is that Upwork is outperforming from a demand growth perspective pretty significantly. And it typically, users of its platform are happier versus that of Fiverr. Some of the key differences you can see in these mentions is that a lot of people reported being able to utilize Upwork for longer term work. And so this is something that now people are, freelancers are able to actually support themselves just by utilizing one of these platforms, not even just as a side gig. And Upwork typically has more complex and more long-term jobs. I know that anecdotally at Likefolio, we use Upwork and Fiverr, but we have Upworkers that have been on our team and been consistently working with us for 6 or 7 years now. So these are really, really long-term positions. I know that, I work daily with team members in Argentina and all the way to the Philippines. And so this really enables that concept of remote work. For Fiverr, we use Fiverr, but it's typically those one-off jobs. So design work and things of that nature. In our experience, the quality of freelancers on Upwork is usually a little bit higher, at least in the longer term jobs that we need. And so this is consistent with what we see in these consumer mentions as well. And these are some of the trends that I talk about that we track. And the reason that I wanted to point this out, because of the working as a freelancer and hiring freelancer, these are mentions of people who are talking about they're either have a job as a freelancer or maybe they're a company and they're working to onboard freelancers. Those mentions are rising on a year-over-year basis. But another thing that's popping is this concept of a hybrid workplace. And I think that this is so important because obviously fewer people are working from home than they were last year. People are starting to return to the office, but this concept of a hybrid workplace really cements this concept of remote work. And so the acceptability for companies to even be open to having a freelancer or someone work remotely is much higher now than it was a couple of years ago. This is much more standard practice. So I think that this is one of the things that's helping to drive continued momentum for both Upwork and Fiverr. And so you can see on this chart here, these are mentions, this green line, these are our mentions of people who are either talking about signing up for Upwork as a freelancer or using Upwork as an employer. And that number has risen by 60% on a year-over-year basis. It's at near all-time highs. So this is an instance where we're really starting to see that divergence opportunity emerge, where maybe we're starting to feel like that Upwork could be a bit oversold. We also take a look at sentiment. Sentiment of late has been dinged by some politicized content. Upwork shut off essentially operations in Russia, and that generated a lot of stir. So that's why you see that 6% year-over-year drop in happiness. But even with that politicized ding, Upwork happiness was still higher than Fiverr, and it's still 80% positive, which in our world, 80% is extremely high. If we were to look at an airline, for example, the percentage of positive mentions would be somewhere in the 40s or 50s. So whenever we see something in the 80s, that's a pretty positive service experience score. That's a leftover one. Sorry about those. The next one that I will hit on is Beyond Meat. And I don't know if you guys have ever had Beyond Meat. Those burgers actually kind of look like what Beyond Meat looks like. I have tried this. I'm not a habitual buyer, so I don't have as much firsthand experience to provide for Beyond Meat like I did Upwork. But what you can see on this chart here is that Beyond Meat is starting to lose some steam. So previously, a few years ago, Beyond Meat was really the first non-meat product to be placed in the meat aisle. You know, I remember that was a big deal whenever you're in Kroger and you're driving your cart through and you look over and you see the hamburgers, patties, and then next to it, you see Beyond Meat. And a lot of people were intrigued because it looked a lot like the actual real hamburger patties, and a lot of people tried it. And for a while, it had this enormous first mover advantage because Beyond Meat was the only, non-meat product placed in that meat aisle and not in a special, vegan section of the grocery store. But now that's shifted. One of its largest competitors, Impossible Foods, they're now located in the grocery store too, along with about a dozen other brands, as I'm sure you've seen if you've been grocery shopping recently. It's something you got to pay attention to. I know I've almost accidentally picked up a plant-based meat, quote unquote meat, before. But the moral of the story with this chart is that now Beyond Meat is losing this market share to other competitors. And you can see on this chart, these green mentions, these demand mentions. I think that they did a really good job of anticipating that huge run that we saw after Beyond Meat's initial IPO, because demand was surging. Some of the highest levels that we've ever recorded in 2019. And then since then, demand has continued to wane. Now, the company got a little bit of a bump whenever they launched the KFC Beyond Chicken Tenders. And you can see, though, that since then, there's been some normalization. In addition, Beyond's consumer happiness levels are dropping. So, prior, you had mentions that were above or near, over 80% positive, and now those are starting to fall on a year-over-year basis. And a lot of times, and what we're seeing, that Beyond is facing some serious pricing pressure. So a lot of people are talking about how Beyond Meat is way too expensive for them, that whenever they're choosing items, they're less likely to pull the trigger because the price difference between Beyond Meat and actual meat options is so wide. And as we see, especially, the mentions of grocery store prices rising and consumers starting to feel that pain from inflation, this is a headwind for Beyond Meat because their price was already higher versus traditional options. So that certainly is not going to help their case. In addition, we're starting to see trends shift away from what Beyond Meat's sweet spot is, from whenever we look at consumers who are talking about following different diets. So all of these are different diets that consumers are talking about that they're following. on a year-over-year basis. And you can see that the majority, some of the highest growers in terms of diet and following are these high protein diets. Even the carnivore diet mentioned, these are rising, pretty significantly on a year-over-year basis. You have people who are adopting this, more Mediterranean healthy diet with fish and high in, those natural oils. But then at the very bottom, you see everything that may lend itself to be a tailwind for Beyond Meat. So people following a plant-based diet, people who are following a vegan diet, vegetarian, even flexitarian, these are all dropping on a year-over-year basis. So this isn't to say that fewer people are plant-based or fewer people are vegan. This is more indicative that all of these diet trends are losing momentum. So they're losing steam. Fewer people are switching over to this type of a diet. And so I think that that's really important to know, though, that because previously people switching to and adopting these diets was a huge driver for Beyond Meat. So that's one that for us, it's so helpful to know how consumers are purchasing whenever they're shopping for meats in the grocery store. So fewer are splurging for Beyond Meat, and also to be able to see the drivers of this, of, okay, these behaviors that consumers are reporting and the actual, mentions purchase intent that we're capturing, these are in alignment. So for us, Beyond Meat is one that we're staying away from. Even though shares have sold off pretty significantly, this isn't one that we want to play to the upside. If anything, this is one that could continue to sell off. So Nvidia, this is one that I think is impossible not to include right now. I know that technology stocks and growth stocks are continuing to struggle of late. And so this could present an opportunity for investors long-term, because what we're seeing is that we're finally starting to see this traction where consumers are talking about being able to get their hands on Nvidia chips and Nvidia products again, which that was a huge weight in the past year as the company struggled alongside nearly everyone else with, just supply chain problems. There's a lack, the chip shortage mentions that we were tracking, I think back in, May and June of last year, that's still real, but we are starting to see signs that Nvidia is improving. In addition, one of the big signs of this is the purchase intent mentioned, or not purchase intent, the consumer happiness rating for Nvidia is rising again. So we're starting to see, signs that people are able to get their hands on the chips that they're looking to get their hands on. In addition, the reports from people who are using Nvidia products are typically extremely positive. This is the brand standard for chips. And you can see that how much some of these chips are going, above even market value right now, that consumers trust Nvidia and like Nvidia so much that they're willing to pay so much more to get their hands on one of the chips. But this is another sign for us, these mentions of consumers who are searching for processing power. So people who are talking about having a hard time getting their hands on these products, they're starting to normalize. Obviously, it is still extremely elevated versus 2020 levels. That's undeniable, but it's starting to get better. So that's good to know. And that's definitely something to continue to watch. And we would want to see continued improvement here. And part of the reason that, we're so confident in Nvidia long-term is just because the company has its hand in nearly every aspect of some of the largest trends that we're tracking right now, from cryptocurrencies to virtual realities to autonomous vehicles. Just anecdotally, I know that Nvidia powers a lot of the new technology in John Deere tractors and John Deere equipment. My dad's a farmer, and some of the technology advancements that these tractors are capable of is incredible, and that's powered by Nvidia. And so it it's hard to think about the future of technology and the future of a lot of these different industries and not consider Nvidia. And at least from our data, Nvidia is the outperformer of the group that we're watching. And then Shopify, this is one of my favorite companies to be talking about today. And so what Shopify does is, I like to think about Shopify as the anti-Amazon. Basically, this company came on the map and started to allow consumers, or allow these brands to reach consumers directly and not have to go through a middleman like Amazon. So, you go to an Amazon or an Etsy or an eBay and you're searching for something. And what Shopify said is, okay, well, how about if we don't make a consumer have to go to one of these sites? What if the consumer can just go to the brand directly and set up shop there? And so Shopify experienced huge growth, especially during the pandemic, as brands and companies immediately realized that they needed to have a really robust e-commerce presence. Because what Shopify does is it, offers a full gamut of solutions for companies, from building a website to, onboarding your store catalog to helping with actual logistics and fulfillment as well, and actually processing these payments. So every step along the way, from launching your brand online to actually shipping and fulfilling that product, Shopify is helping these companies do. And you can see that mentions of consumers who are the fact that we even have brands and companies that are talking about using Shopify to help their brand, I think is really impressive, that there's enough of a sample size for us to track this. And one thing to note here is that, after the pandemic, there was a bit of a slowdown in just e-commerce growth. I think this green line that you see, these are mentions of people who are talking about, using Shopify as a platform. And you can see there was a slowdown for months in 2021 versus 2020 levels, as things kind of tempered, because, people, if you were going to bring your company or a brand on, you did it at the onset of the pandemic. And so that's that huge surge that you see in early 2020, that green line, the slope is really steep. And then started to lose a little bit of momentum, which is normal. It's a little bit of a pull forward effect. But now we're starting to see this inflection point. So we're starting to see those demand mentions tick back up again. So we're seeing more engagement, and we're seeing users continue to adopt Shopify, and new stores continue to adopt Shopify. So this reach is expanding, and it's starting to move in the growth direction. Again, it's really starting to gain momentum. In addition, happiness is extremely high, above 80% positive in our book is really strong. And I think another thing that Shopify is doing is they're starting to connect with not just those brands and companies, but now they're starting to connect with the consumer. And this helps the brands and companies, because what they're doing is they're allowing, whenever you make a purchase, let's say on your phone, it's so much easier to be able to check out with something like an Apple Pay, versus having to go find your credit card and input all of your credit card information in those tiny fields. It is maddening. And so Shopify, they added Shop Pay on checkouts for these different brands, and it stores all of your information securely so that you can just one click, it has your shipping address, it has your payment information, and it easily completes that purchase. But then not just that, it tracks it. So you can hook up all of your purchases, or your purchase history within Shopify, and track whether or not you made the purchase via a Shopify platform or Shopify checkout or not. So for example, I use Shop Pay every day. Not every day. Every time I order something, and I have it hooked up to my email, I have it hooked up to my Amazon account. And what it does is it alerts me every step along the way whenever I've ordered something, like, oh, your package is on the way. And it really provides this one-stop shop for consumers. So I think that these elements, this consumer facing element, as well as the business facing element, is really smart, because if you're Shopify, you want consumers to check out using Shop Pay. And if you're a consumer, you're more likely to use something that's already got your information and stored and really easy for you to spin up. And so this would be this I think is something to keep an eye on. You can see the adoption mentions on that green line are up over 150% year over year. That's definitely helping to drive that Shopify total demand growth. And one thing that Shopify is doing too is, it's extending beyond just what you would think of as a traditional website. So, going to Nike.com to, search for the shoes that you want. And it's integrating directly with a lot of these social media platforms. And I want to show you this, this trend chart, because I think it's very, very interesting. So mobile shopping is a subset of e-commerce, to be clear. If you're making a purchase on your mobile device, you're making a digital purchase. But you can see that the number of mentions from consumers who are talking about actually shopping or buying something from their phone or from their mobile device is growing at a much quicker pace than generic and overall mentions of e-commerce. And I've highlighted these TikTok purchases as an example, because what Shopify has done is they've enabled you. So let's say you're scrolling TikTok or you're scrolling through Snapchat. You can literally just click and buy the product that's being featured in the TikTok or on the social media without ever leaving the app. And they're allowing brands to use this technology. And that's extremely powerful. This whole concept of social commerce is an area that we're watching really closely, because we see consumers increasingly talk about buying something that they saw on Instagram or buying something that they saw on Facebook, buying something that they saw on TikTok. And it makes sense because it's so easy to make these purchases directly when you're there without even having to leave. And if you're a brand, you want the technology that allows you to do this. You want to make it as easy as possible for consumers to shop with you. So these are just some reports of business updates, but overall, this is one of the companies that we see continued long-term growth prospects in, and we're leaning increasingly bullish for Shopify moving forward, especially from a long-term position. And then the last one that we'll hit on today is Target. And Target is somewhat similar to Shopify, because Target has adopted a really cool strategy. And on this chart, you can see this is Target versus Walmart and Amazon. And this is just those near-term mentions. And you can see Target is the furthest to the right. So the mentions of people who are talking about shopping at or with Target are growing, whereas we're starting to see some tempering with Amazon and Walmart. And you definitely see a huge happiness chasm between Target and Walmart. Walmart's below 60% positive. Target's almost 70% positive. So, a more than 10-point gap between the number of consumers who report a positive experience with Target versus a positive experience with Walmart. And this is pretty significant for us. This gap is growing. I don't think that it surprises anyone to see Target higher than Walmart, but it's important to be able to keep an eye on this, not just from Target's perspective to confirm that the company is continuing to outperform, but to also watch to see whenever Walmart begins to make improvements or continues to lag. So Target's demand growth, it is normalizing, but I think that one thing to keep in mind is one driver of Target's growth of late has been, this increased average ticket size. So that's not necessarily going to be reflected in our data, but we do know that the average amount of sales per store that's rising, and what consumers are spending is rising, regardless of the trips that they're making to the store or the number of orders that they're making. And for us, what's most powerful and what's most from a long-term perspective, the most forward-looking is Target's consumer happiness. And so, I mentioned that Target is outperforming Walmart, but to see improvement on a year-over-year basis as well, you can see that happiness mentions is getting stronger. And not just that, but it's pretty consistent. Whenever we qualitatively look at tweets and see how consumers are utilizing Target services, they're all mostly very positive mentions. For someone to call spending money a comfort store is pretty rare. Also, you'll note the mention from people who are talking about using Target's drive-up service. So Target was really smart whenever it realized that it could all of a sudden, leverage its massive retail presence to help fulfill a lot of these, increasingly digital orders. So consumers could just drive on up, park in the parking lot, and they'll bring things out to you. Another really interesting thing that Target's doing well that's helping to drive demand is they're collaborating with these brands. One in particular that we're watching that's performing very well is Target's collaboration with Ulta. We're seeing mentions of Target and Ulta. So, someone talking about they shopped with Ulta and Target in one of their store-in-store experiences, or maybe they ordered a product from Ulta, but on Target's site online, perhaps even had it delivered, was shipped. We see a lot of those, and those are increasing. And so this brand partnership, the Ulta Target brand partnership, for us looks like a really good fit. And so we'll continue to monitor that for continued growth. Target also does a really good job. I don't know if you can see this on this picture on the bottom with the colorful bags. This is a brand called Stony Clover Lane, or Stony Clover, and Target partnered with them to bring this really fun, springy product lineup to its stores. And I can tell you, I was in Target, unbeknown to me, on the day that this brand launch happened. And it was like a frenzy. There were people who were waiting as the Target representatives were continuing to unbox and restock shelves to see what products that they were putting up there. And so, other brands that Target's partnered with, for example, I know that they partnered with Levi. I know that Target also has a partnership with Disney for Disney products. So they're very strategic with product offerings, and that helps to drive happiness, but it also brings people into its doors. And I think it shows that Target has a good connection with its consumers and understands really what its consumers want. This chart is kind of demonstrating partially what's driving Target's success. And a lot of that are, Target's omni-channel options. So Target has a good experience if you go shop in its store, but Target also has a good experience if you want to drive up and pick something up. Target also provides a same-day delivery option. And so I want to go through this chart because what you can see, this chart on the left is, mentions of people who were talking about, if they ordered something, how fast it was coming. So maybe they talked about they got 2-day shipping, or my product will be here in 2 days, versus, I ordered same-day delivery, or I'm using curbside pickup. And what you can see is that in just 3 years, COVID was an enormous adoption spark. COVID definitely spoiled us as consumers. And so our expectations are now higher than ever. Now, 2-day delivery is not fast enough. I know I get antsy at 2-day delivery. I am completely spoiled. I definitely love same-day delivery, and I definitely utilize that curbside pickup, and deliver to your door. But you can see a complete shift just in those 3 years. And what's incredible is that Target was already ahead of this. Well prior to COVID, Target acquired Shipt, which is a same-day delivery service. So they were already in the process of integrating and being able to offer all of these services so that when something like the pandemic occurs and when fewer people are shopping in stores, they were ready to transition to this type of a service. And that just showcases Target's forward-looking capabilities. But for us, it now I believe that the company fulfills on their last report, they said they fulfill more than 95% of their digital orders from their stores themselves. So from a logistics perspective, this helps Target be really efficient and help meet those really high standards that consumers have and that are only getting higher. And you can see these are those same day fulfillment mentions like I talked about on this green chart here. And obviously huge adoption spark in May of 2020. Internally, we call that bump whenever we see that, it looks like a shark fin because it was so alarming. There were so many people who were talking about all of a sudden doing this thing. And then you see in the holiday season, the first holiday season while we were in the pandemic, there was obviously e-commerce and same day delivery that, you know, any way to get the product that you needed that day, but not have to go in the store, extremely utilized. But then what we like to see is that there was continued growth after things have normalized. And so now that things have normalized, or, you know, as normal as they have been since pre-pandemic, we're still seeing those mentions elevated. Those daily mentions are still 65% higher than they were in 2019. So that tells us that this was a permanent behavior change for consumers, that a subset of consumers are going to continue to utilize these types of services that Target has. And so this can continue to be a tailwind for Target, or we expect it to continue to be a tailwind for Target moving forward. And you can see, I love this, if the second to last point that you see on this, and it's bolded, is the company noted that its omnichannel guests, so people who are shopping digitally, shopping on Target's website and also visiting a store, spend 4 times as much as its store only and digital only guests. So Target knows that it needs to have a really robust experience on both sides of the lane to really boost its sales conversions. And I do think that that's one area and one specific area leg up that Target has, at least in our data, versus a Walmart, whereas Walmart might have a really nice digital experience. Its in-store experience is lagging. And so it's not getting quite the synergistic effect that we would expect from Target moving forward. But we'll definitely keep an eye on it and see if that changes. And so, you know, I'll kind of shift out. Those are just some names that we're watching right now that we think could develop into opportunities. 4 of them, I believe, are bullish, and then Beyond Meat was more of a bearish one. But one way that you can engage, if this type of data and these type of insights are something that seem valuable to you, we have a daily drop. And what we do is we send out, it's usually around 3 topics each day of things in our data that are popping. So the one that I have on the screen right now from Foot Locker, that was from yesterday's drop, but it's completely free. If you go to likefolio.com and you look up in the right-hand side, you can sign up for the daily drop, and you can unsubscribe at any time if you get annoyed. But in my opinion, this is one of the most valuable things that we offer, because many times we will give away the ideas that will eventually become an alert before they become an alert. You know, we'll highlight things that we're watching before we actually pull the trigger. And I think that, you know, one thing that we try to do is put the data in a way that makes sense to people whenever you're reading it, that you don't have to be, you know, a professional, or this doesn't have to be your life for you to understand, oh, okay, this is how consumer behaviors are shifting, and these brands are becoming more or less popular. And it's just a nice gut check. It's a nice check to have, because you never know whenever maybe we spot something, you know, disturbance in the force for a name that you're involved with. And that's always good information to have to be able to use as supplemental research to your own trading strategies. And then you can also catch us every day on the TD Ameritrade network. So we participate in the cash tags in their fast market segment, and we're on every day for 10 to 15 minutes around 12:30 Eastern time. This screenshot's actually from today. So I spoke today about Snapchat ahead of its earnings. And this is just one way, again, another free way to connect with us if you'd like to. So I think that about wraps it up for me, but I will put this up there just in case you want to check out our website, learn more about us, and engage with some of the options that we have for just individual traders.